Welcome to our Dealmakers Week webinar. I'm Emilee Wentland, Managing Editor of Franchise Times, and I'm excited to have with me today our three panelists, Rick Ormsby of Unbridled Capital, as well as Kevin Burke and Scott Romanoff of Franchise Equity Partners. Rick is the Managing Director of Unbridled Capital, and he has 20 years of experience in the franchise investment banking world. He's worked on hundreds of franchise deals. Welcome, Rick.
Hey.
Kevin started as a partner in Franchise Equity Partners about a year ago in March 2023. Before that, he founded Trinity Capital, where he was managing partner. In his time at Trinity, the firm completed more than $20 billion in mergers and acquisitions, financial restructurings, and financial transactions. Welcome, Kevin.
Thank you.
Scott Romanoff is the co-managing partner of Franchise Equity Partners. Previously, he worked at Goldman Sachs for nearly 30 years. Welcome, Scott.
Great to be here.
Our panel today is called Do's and Don'ts for Franchisees Accepting a Private Equity Investment. Today, we'll be speaking about green and red flags when it comes to accepting PE capital and the possible long-term benefits and consequences of doing so. So let's dive in, and Rick, we'll start with you. Can you first tell us a little bit about Unbridled Capital for those who aren't familiar?
Absolutely, glad to, and thank you, Emilee. And I would say I'm definitely honored to be here with Scott and Kevin. These are some folks who are quite smarter than me, so I'll learn today more than I'll probably contribute. But yeah, Unbridled Capital's been around for a while, and we help people sell and finance their companies. I wrote down a couple of notes of things that may be interesting to you. I guess this year we won our 6th Dealmaker of the Year award, which is pretty cool, and we're honored for that. It was because we closed 17 transactions in the most recent time period, which is a lot, because the market hasn't been very good for the last year or so. Last week we sold 33 Little Caesars in Michigan, and this week 65 Wendy's in Pennsylvania, Ohio, and West Virginia for the Thompson family. So that's kind of cool new news. I do a podcast called The Restaurant Boiler Room. You might find that interesting. But a little known fact about us: Unbridled Capital was named after Unbridled, the horse, in the winner of the 1990 Kentucky Derby. And Unbridled went on to sire Grindstone, who is the 1996 Kentucky Derby winning horse. And so as a sire, Unbridled was actually more famous than as a racer. And that's how our company came to be. We're from Kentucky originally, but we're now in the Panhandle of Florida. That's us.
Sure. Thank you so much for that. And what deals has Unbridled completed in the last, year or so that have involved private equity?
Yeah, great question. I took, pardon me for looking down at my notes here, but I kind of studied the last couple of years here and thought I would pass this along. Maybe Scott and Kevin have some interesting, can think about this too. But, in 2021 to 2022, 23, and 24 estimated, I would say that in 2021, we completed somewhere around 35 to 40 transactions. 22 of them, so a little over half of them, were sold to private equity companies. And 6 of those transactions were new private equity entrants into the space. Interestingly, in 2022 and 2023 combined, we have maybe a little over 20 assignments that we've completed. 7 of those have been to private equity, and none of them have been to new private equity. And so, what we saw during the last 2 years is that over half of our transactions were being sold to owner-operators, actually, and very few were being sold comparatively to private equity groups. And we can talk about the reasons why that's happened. And then for 2024, we're projecting, if we sell 15 assignments this year, that maybe 40% of them or so will go to private equity companies. And we don't think there'll be any new entrants who are coming into their first private equity investment in the deals that we're doing. There might be one, but there's been a pronounced kind of downshift of new private equity into the space over the last 3 years after what was really a gangbuster time from 2000, Kevin, 15, 14, all the way to 2021. So that's kind of the trend we see. And then when I'm talking about PE that we've seen in the deals that we do, we've probably participated in probably 10 or 11 brands over this time frame, and we have brands that we've put PE either existing or new into would be Taco Bell, Sonic, KFC, Pizza Hut, Popeyes, Papa John's, Dunkin', and Burger King.
Rick, from your perspective as a sell-side advisor, what would you say are some of the green or red flags for franchisees when it comes to accepting that private equity investment?
Yeah. And, again, I think, Scott and Kevin are going to have a really interesting perspective here because they're the ones actually making the investments, right? And, of course, Kevin had the experience prior to that working on the advisory side. Most of our assignments actually that are involving private equity, they're usually a selling franchisee. I mean, they're not all this way, but most of them you would picture a middle America selling franchisee who is walking away from the business, not continuing with the new private equity investor. We have had a couple of examples of groups that where the franchisee stays along, and so. I mean, this is just a handful of things I would talk about that I just kind of wrote down here. I mean, some of the things that I would say could be red flags are what's the experience of the private equity firm? It's kind of the first thing that I ask and look at. If I'm going to be an operator who's going to sell part of my company and continue to partner with a private equity group for 5 to 7 years, or who knows, even longer, I look at their experience and their track record. There are, for every deal that we do, there's probably 50 private equity, 75 private equity firms that talk about wanting to be in the space, but very few of them actually do it. So I like to see people with a past track record. Obviously, Franchise Equity Partners has that. And, I want to see what their past success and failures are as well. It's a very small industry. These gentlemen and I know a lot of the same people. So you want to get references and you want to talk and find out what the reputation of the private equity group is. And if you hear anything bad, I mean, honestly, like if I hear one piece of bad news, and it's kind of like being a restaurateur. If your clients will never say, your customers will never say good things about you, but if they had a bad experience, they'll say it really quickly. If you hear one piece of bad news about a potential private equity group, in your reference checks in the industry, I think that's a big negative and something to be mindful of. I think you look at the personal fit between the principals of the private equity group and the franchisee who's going to partner with them. And if it's like sometimes just like the good old days, if you have a 10-minute meeting and you don't like the person, that likely means that it's going to be a 80% chance or greater that it's going to be a bad partnership, right? I mean, all the other things aside. So you look for personal fit. That would be a red flag if you don't have a good personal fit immediately. If you're not over a course of a couple of discussions, if you don't get a lot of clarity on your compensation and your growth and how you're going to fit in specifically to the future of the business, then I start to wonder about that as well. So clarity and compensation and what's in it for the operator are obviously, those things have to be first and foremost in the operator's mind. And so you want to make sure those things aren't forgotten. I mean, I think I also look at the type of private equity person and company and what they've invested in the past outside of the space. So, for example, like I was telling you before we started, I was in New York last week, and I met with like 4 or 5 different groups up there, and they're decidedly different types of companies. One of them is a growth investor that if they're going to be in this space, they want to invest in brands that are really growing fast and are the premier brands. Like, let's say they want to buy the Mercedes type of business. And then one of the meetings I had was someone who wanted to buy the old beat up pickup truck that barely operates and they want to turn it around. So you want to match the type of company you have and the type of philosophy you have as an operator with the type of investor you have. You wouldn't be a good investor or a good operator for a fixer up, don't spend any capital here, put a Band-Aid on it and make the operation better. If you are the type of person who's building new units and excited about the premier brand that you have and that you want to grow. So that's another item. And then I guess I would, if I had anything else to say, I would say, what does the support structure look like at the private equity group? I mean, they're going to be your partner. If it's just one dude, be wary. Be knowledgeable about what the support structure is, because the support structure of the private equity group is the real strength in what they provide, not just the money. The money is one thing, but I mean, really, there's lots of money around. It's really the relationship and the support structure. And if you feel like you get the heebie-jeebies when you start asking about, how they're put together and who's on the team, I think that's probably a red flag for you.
Scott, let's pivot to you. Can you tell us about some of the more recent deals at Franchise Equity Partners that have involved franchisees? What made those attractive from, your perspective?
Sure. And again, thanks for having us. And it is great to be here with Rick. He really is at the epicenter of restaurant transactions and knows the difference between private equity and strategics, and a lot of what he says, really resonates with us. To answer your question, Emilee, we basically, as minority investors who invest like a family office on a permanent basis, we start with kind of two premises. Premise one is, we just want to work with the best-in-class operators. Because we're a minority and because we're going to be permanent, we're going to look for the long term. And it's a little bit like Hotel California. We don't craft an exit strategy on day one. So the partners we select, better click with us, and we need to have a lot of confidence in them. And at the same time, not only are we marrying with the partners, we're also marrying with the brands. And same thing, we're going to be in these brands for the long haul. So they need to be franchisors that, we think are going to be supporting the business, supporting the system, and folks, we want to represent in the market for a very, very long term. So, the type of businesses, we like to focus on are the ones that have a lot of brand equity, have a lot of customer loyalty, and irrespective of the vagaries of being in the restaurant business, day in and day out, they're going to have customers who are going to want to dine at these types of businesses.
And so, Kevin, turning to you now, from the perspective as someone who's experienced in the private equity space, and Scott, feel free to chime in here, what should franchisees be on the lookout for in regards to accepting a PE investment or not?
Well, I think that, echoing some of what Scott said about FEP, it's important to have a partner, not an investor or not an owner, if you will. And I think that, everybody in the private equity space is very loquacious about their partnering, but there are people that actually partner with operators, and there's those that buy them. And, it's yesterday you were a prospect, today you're a client, and it's a different environment. So I think that, the things that private equity firms should be looking for is, well, first of all, they should ask their counsel to run a LexisNexis report and just make sure that your private equity partner is not, overly litigious and has, a big stack of, court cases. I think that's something that is perfunctory, but also it's a little bit of a canary in the coal mine, if you will. I think other things to do are, as Rick had mentioned so eloquently, you got to go down the checklist and talk to people in the industry, find out, about the deals that the firm didn't do, the ones that they pursued and how that turned out. Find out about how the failures did, because the great deals are the ones that are always front and center on the website and that they talk about. But you should, shoot for the middle, because not everybody's going to, have the best deal of their life every time. I think other things to do is to try to get into a little bit of specificity about how they would interact. And again, hearkening back to what Rick said about, having a team. So for instance, we have a team of data analytics professionals that, can help, scrape the web for pricing information, for sales information, for real estate, issues, and other things in the P&L. And that can be of tremendous benefit to a franchisee who doesn't have the width or breadth or financial resources to, staff a first-class team like that. Similarly, we have financing experts that, can, if the franchisee wants, assist them in running a really thoughtful process of obtaining financing that best meets their objectives. A lot of people, a lot of franchisees check in on interest rate and maybe a couple other things, and they're not looking at documents, they're not looking at hedging provisions, they're not looking at, a call on a loan, and so a lot of times, it's sort of quickly assembled, and we can be very helpful with that with, our finance team. And then I think that, supporting a franchisee is also, being there when they call you, at nights and weekends and whenever, and really developing a comprehensive relationship, more friendship in addition to your business relationship, so that they confide in you and you have more frequent conversations and more productive suggestions back and forth, and it's not a stiff quarterly board meeting. And I think that, and the firms that have done a good job, their reputation precedes them. And I think that investment bankers like Rick are very clued in on those that make real partners and not, owners, if you will.
Kevin, at Franchise Equity Partners, when you're evaluating, possible deals, what do you look for? Like, what makes you think, these franchisees have it together, they're going to be a great partner for us? Right.
Well, sort of the inverse of what I just alliterated for, what should a franchisee be looking for? So, Scott and I and our other colleagues, we're always looking for character, first of all, because you can work your way out of a bad deal with a good character, but you can't work your way out of a bad deal with a bad character. So, we really want to make sure that we're dealing with people that have, a great, a great integrity and a great reputation, and care about people, and are, not ruthless and so forth. And that's sort of a first screen, and you just get to know that by socializing with people in the industry. I think that, after that, we look for good brands that have good advertising funds, good brand leadership, are not, like, for instance, one of the top 25 brands, when they sell things in CPG world, they remit half of that money to the franchisees. Most of the top 25 concepts, when they have a CPG deal, franchisees get nothing. In fact, they probably get a little bit of encroachment. So, I think there's brands that are, more to our liking, and ones that, perhaps are not. And we have to, do our work on the brand to make sure that we've got a trustworthy partner. Now we've got a trustworthy brand. And then the next thing we look at is, financial diligence. And one of the best things to look at is, if you look at an FDD and you flip it around backwards, if you turn to the back, there's litigation, and hopefully there's only 1 or 2 pages. And then there is stores at beginning of year, stores built, stores closed, stores at end of year. It's almost a given that when you see that number getting bigger every year for a long period of time, it's a really good referendum on the brand. And, we look for things like that. And then I think the other thing is the EBITDA margin as a percentage of sales is a really good referendum on somebody's stewardship of the business. That they're growing right, they're remodeling right, their labor is right, their food cost is right, their paper costs. I mean, they're really managing the business, that not just the top of the P&L, but they're looking at everything. And those are the kind of partners that we look for, that are scrupulous and looking at things like that, because we do too, and we're going to have a better partnership if we agree that no stone should be left unturned. And those are the kind of things you find out during diligence and meeting with people and doing your homework, in the marketplace. And I think that our structure of investing between 20 and 49%. I think it's rather unique. Something like 90% of all private equity funds raised are control funds. And so the ability to be a real partner financially, because if you come in and buy somebody's company and you get a loan on it and you put in the minimum equity, you maximize your leverage, minimum equity, you're really leveraging the equity of your partner in that structure. And so I think a lot of the controlled deals are, not as aligned as we are if we come in and invest 45%, and the upside opportunity for our partner is meaningfully higher. And if we get into quicksand, we look at each other and we're both in trouble, as opposed to somebody having a management incentive plan that is, de minimis in the total capital structure. That it's just a better alignment of interest, and we're really comfortable with that. And our portfolio clients are very comfortable with that as well.
I was going to jump in and just say, as I heard a couple of things that Kevin said, one thing came to mind. I bet, we all have to screen for a fit in a sense of whether somebody can have a partner or not. I think a lot of these franchisees who built these businesses have done them as entrepreneurs. Heck, I kind of feel like that's what I am in a sense. And so, I look at, if I was looking at partnering with another company, I've got to give up a little bit of what, of myself, so to speak, if I'm going to bring on a capital partner. And I'm sure these gentlemen, whether there's a formula of how to assess that, or whether it's a feel, it takes a certain type of person who can take a, whatever, 30, 40, $50 million EBITDA business that they've grown with their own hands, and then, kind of partner with it in the next phase. It's not everyone who can do that. And I would, I was going to say, and not everyone, maybe not even many people can do that. It's actually probably only a handful of people can do that well.
Well, that brings up something I thought of. I've got a long-time client that, I really love. And to your point, Rick, he's absolutely not partnership material because he has very thin skin. He wouldn't take constructive criticism well. His G&A is a bit of a hay barn, and it just you're absolutely right. I mean, some people are born to be partners, and some people don't fit into that as well.
The point Rick is making is really, critical about scale. And, as we think about all the different screens around partners and brands, Kevin's mentioned them all, and some of them are just table stakes. You want to be with people that you want to have a meal with. You want to be with people who have integrity. But it's a unique entrepreneur who can actually go from running a 25-unit operation to a 75-unit operation to a 150-unit operation. And you need to really partner with those types of folks if you're going to look to deploy your capital into growth businesses. And that's obviously, the dream of every investor. So having not only a growth mindset, but having a track record and the wherewithal to scale is really, really important. And, that's also where we feel like it's a little bit of our secret sauce and our value add, which is basically not only giving people the checkbook to grow, but giving them the support system to grow. So rather than forcing an entrepreneur to decide between growing or selling, because they don't have the capital, we would give them the opportunity to not only access some growth capital and remain in control, but have things like a investing team to help them think about the optimal capital structure, a capital markets group that can help them scale their bank relationships to the next level, and then have a data analytics function that'll allow them to compete with the top 10, top 20 franchisees in the country, but not be able to kind of support that on their own. So there's a bunch of skills not only that the operator needs, but the capital partner also needs to bring to the table to help an organization get to the next level.
Yeah, thank you for that, guys. Back to you, Rick. In your experience, what are the long-term benefits or even consequences of franchisees accepting private equity money?
Yeah, wow. Well, I kind of started jotting down answers here because the page is like scrolling this long, right, of things to think about. I come from the standpoint, I'm generally not, a realistic or slightly optimistic guy, but I will make this comment. I don't think that, I'm a general opinion. My general opinion is that, less than half of the partnerships actually work out. Like that's just, I don't have any data to support that, but I would say I come from the mold of, maybe I'm a little cagey like that I think it's probably not going to work out well, 60 to 70% of the time. And so I look at things through that lens when I think about partners of any kind. So from that lens, I say, what are the consequences? Well, positives and negatives. Let's start with the positives, then we'll go to the negatives. The positive consequences are, you hope when you do something like this, that this is a way to monetize some of the value of your business that you've spent your whole life creating. Many of these folks, me included, have spent so much, time and blood and sweat and tears into the businesses that we have, that they look to us more like a spouse or a child than they do a business. We care about them that much. And it's very emotional and very difficult to figure out how to extricate yourself from these businesses, number one. But number two, you have a lot of value and most of your net worth likely tied up into these businesses. So this idea of marrying up with a partner, if it works out well, maybe, taking some of the money out of your business and placing it in your pocket, but then having a partner that can help you scale it and grow it to maybe have even a better outcome in the future. In theory, that's a really great positive consequence. I'll also say, as an aside, the franchise equity guys, like it is true. They are very unique in their minority investment, what they do in our space. There are very few that do it. So for those of you who listen or watch, that's absolutely right. They're unique in that way and valuable in that way. And I think it's an area of the market that we're going to see, more and more activity in. You're also going to have the positive consequences or the capital to grow. We've talked about the positive consequences with, data analytics and capital markets and some of the things that become really difficult for someone who just runs a business and wants to please customers and wants to keep their employees happy. Some of these high finance things are just not, they're just not overly familiar with someone who's built a business that needs to become 2 or 3 times stronger. So most franchisees I know that own a 50-unit business or whatever the number of units is, most of them are woefully underestimating that value. They really are, and there's a lot of synergies they're missing with the financing and the and the analytics of their businesses. It's like an area that they don't really use or see much of. You have a little bit less personal pressure of running the business. You're probably still going to be on a personal guarantee. You're probably going to be the face of the franchise to the franchisor. You certainly have a partner and a capital provider that you're going to have to answer to. But there is some element of you have taken some of the value of your business off of the table, and you have a team around you instead of the pressure of being, a sole proprietor, so to speak. And that's a real thing, having gone through COVID and some of the last 4 or 5 years. I see the psychological and emotional fatigue that some of these operators go through. It's a lonely place, Emilee, to own a business. I don't want to sound like woe is me, but everyone wants to paint a business owner as somebody who has it made all the time, and it's absolutely not true. It's a lonely and sometimes dark place to be, to not have partners around you to rely upon. And that is a big benefit, a big green flag, so to speak. You hope that if you marry up with Scott and Kevin and team or somebody like them, that you're producing long-term economic value for you and your family, and maybe a way to structure it that, the gross proceeds of your net worth are higher, but also the net proceeds of your net worth are even higher than that, because they have all kinds of creative ways to think about creating and holding and keeping value. And then there's also, some people get to walk around with fancy shoes and a nice suit, and they have the power and prestige of having a big company behind them, and that's pretty cool too. That doesn't do it for me necessarily, but it does for a lot of the franchisees as they grow their businesses. And you'll see them flying on private planes and having Gucci shoes, right, guys? But some of the things I would talk about for red flags, though, to be cautious of. And I know a lot of people say they talk to private equity, and and it's a kind of a buzzword. It has been for the last decade. The loss of control is a real thing. Be cognizant of that. It's a real thing. I will say that private equity, like anybody else, doesn't really want to spend money if they don't have to. They would like to borrow money, right? That's the highest return. So, a lot of people erroneously go down the route of exploring this avenue, thinking that they're going to have and this is maybe less sophisticated folks, but thinking that they're going to have a private equity group that's going to write an equity check for the entire value of their business, and then going to have an equity check ready for every capital expenditure that they do. Well, that's not the way a private equity group maximizes their return on investment. So they're going to be borrowing money. They're going to be scrutinous on how they spend capital. You can go drive around in a lot of the areas of our country, and unfortunately, you can see private equity deals gone bad with potholes and roofs that are leaking, and windows that are all fogged up, and closing hours that are sooner than they should be, because of some private equity groups don't want to spend the money, right, and make the long-term capital investment. You have to think about your job security when you have a new partner. You're not your own master of your own fortress, so your job security becomes a bit of an issue. And you'll likely work harder for a private equity group partner than you would working for yourself. Differently, but you'll likely work harder. Some people might have the erroneous perception that if they take some of their money off the table and partner with the group, that means they're going to be on Easy Street and hanging around for 20 hours a week and providing some expertise. That's not what Scott and Kevin or anybody else is really looking for. You know what I mean? They're looking for someone that young and strong and ready to roll. They get their return by building more units. That's one of the biggest ways they get their return. And it takes energy and time and gusto to build more units. In many cases, build 30 or 40% more stores than what you currently have. So that's a misperception. Lastly, I would say, and this is a kind of a whammy, so I'll say this about the negative consequences, and you guys might disagree. We are just now getting kind of into the phase where the first and second wave of mainstream private equity groups are selling the companies that they bought. Now, there have been some notably strong and really good examples, especially in systems like Taco Bell and others that have been great brands. But there are a lot of quiet examples of private equity firms who have had a really bad return. And those don't get talked about a lot, but they're out there. And I would say they're out there 3-to-1 over the ones that have a good return. So I think there is this quiet concern out there, both amongst the private equity groups, but also amongst the potential operators that invest with them, that this second person, the operator, is just now becoming aware of it. That the returns may not pan out what we think they will. And the risk is higher than what we thought it was.
Yeah. Rick touches on so many important points there. I think first and foremost, his point on control and working is really resonates. First and foremost, I think when someone thinks about taking on private equity, they should think about where they want to go rather than where they are today. So if you kind of like the status quo and you're a 25 or 50 unit operator and you're getting a nice cash flow every year and you like kind of the current state of your platform, you probably should just stand pat. If you want to take your business to the next level, the math you need to think about is, am I going to have a bigger pie, but only own 60% of that pie, rather than own 100% of something smaller? And if the scope of your ambitions is to be a multi-hundred unit operator, that's probably going to be a better result at 60% than 100% at 25 stores. But I think you got to really have that growth philosophy before you look for a capital partner. When we started Franchise Equity Partners, we actually thought the biggest profile of our partner would be the first group that Rick described. So for example, in the automotive space, the average age of a automotive dealer owner is 71 years old. So that is somebody who's kind of in the back nine of their career. They probably want to start doing some very rigorous estate planning if they haven't done it already. They want to take chips off the table and diversify, maybe set up a charity or a family office. So we thought our capital would actually be very well attuned to that group. Well, we found out we were completely wrong. The partners who tend to actually seek us out are the 45 to 55-year-old entrepreneur who has got a lot of gas in the tank, who has seen the success of the 1,000, 2,000 store, Flynn type operators and want to go from where they are to there. And what they realize is to do that, they need a capital provider partner that's got a checkbook and that's got a range of skill set. So I think when people think about the partner that they're looking for, before they think about that partner, it's probably good looking inward and looking in the mirror and saying, what do I actually want to achieve the next 10 to 20 years of running my business, and use kind of the capital partner as a means to an end rather than an end in and of itself. I think the other thing that I can't emphasize enough that Rick alluded to around failed deals and kind of, it's not just easy money in the private equity space. We've seen a lot of operators agree to partner with independent sponsors who really don't have committed funds or committed capital. And Rick can attest to 6-month, 12-month, 18-month processes that ended with a lot of legal bills and accountants' bills because the capital provider that came to the table didn't really have funds to back them up. And I think is just a matter of base due diligence. Not only do you want to make sure you like the person, but you want to make sure they actually have the capital committed to achieve the objectives you want to achieve.
Yeah, it's a big issue. I mean, no doubt about it. When you hear independent sponsor, that's somebody who's got a phone and an email account that doesn't have any money. So that's someone you gotta know about.
And I think that some of the there's been some very successful deals with PE going back to I think I did the very first deal in 1997 with Sentinel. But there have been a lot of very successful deals. And when I look back on them over the years, what I see is that the firms that, depended on leverage and multiple expansion, if they timed it right, they did okay. And if they didn't, they didn't. What I mean by timing is not necessarily the economic environment, although that's important. I mean the sine wave of restaurant fortunes, if you will. And there are times when these restaurant concepts can't do anything wrong, and sales keep going up, margins are going up, everything's great. People throw money in the air like confetti. And there's times when you can't get a bank to talk to you because there's been so much malaise in the brand. And so I do think that if you're just coming in trying to get lucky on a nice leverage check and multiple expansion, that's not a very solid strategy. And for a franchisee, they should be wary of that, and then a PE shop should as well. And I think that some of the things that we talked about that we do at FEP, with the capital markets program, with the data analytics team, with comprehensive P&L management and looking, no stone goes unturned. And you need a partner that agrees with all that and is comfortable with that. and is capable of taking feedback or constructive criticism. If you've got that, then you have, I think, the leverage in multiple expansion can help you if it does, but even if it doesn't, there's money to be made if you bring some skills to the table. And that's being a real partner, not just walking into a casino and putting a bunch of cash down on red 24. And then the other thing I would say is that, in the beginning, there should be a real thoughtful conversation on philosophy of remodels and development and acquisitions and P&L management, that both parties are not leaving the hard conversations for after the deal closes, but actually saying, look, we want to build, we want to remodel on time or even in advance. We want to do things that are accretive, and we just want to make sure that we can agree on that, and that's not going to be forbidden territory because one party is more interested in distributions, the other party is more interested in growth.
I might jump in. Kevin, you said something that reminded me. The private equity, is very much growth minded. Scott mentioned it too. I think if you are an operator and you've heard about private equity investors and you're looking if you're thinking that might be a way for you to grow, would it not be a good idea, just like one of many things to think about, to say, is my brand a brand where the unit count is growing and I could build more stores? Because that's kind of the primary. You can have same store sales going up, you can grow through acquisition, but the primary, but really one of the primary ways in which a private equity firm gets the return is when you have the new unit development. And if you don't have a brand that has that, you as an operator probably should be thinking, I may not be a good candidate for most private equity groups. Is that a fair statement? Because a lot of the brands that not in automotive necessarily, but a lot of the brands that we're talking about here and that we're involved in on a day-to-day basis are legacy brands, aren't they? That have 1% to 2% same-store sales growth. Unit counts are dropping by 1% to 2% to 3% to 4% a year, and it's really the only way to grow is through acquisition. And the strategy of trying to get a beachhead investment or invest with an operator and then tack on acquisitions at a lower price is really not playing out to be that good of a strategy necessarily.
And I think a lot of that is doing homework on brands and then also looking at saturation in consumer. And I think a lot of people make an investment or two in this sector and think that they are experts. And after 30 years of work or 35 years of work, you can clearly say you're probably not an expert because there's so many things that can go wrong that you don't have control over. And the best thing you can do is set a good foundation at the beginning with your diligence, with the people you do business with. And, make sure that, when I say diligence, there's 400 Taco Bells in Florida and there's 400 Taco Bells in Ohio. Ohio has 10 million residents and Florida has 23. Where would you rather be? And these are the kind of things that if you do that homework up front, you're going to make better decisions and you're going to have a better partner because you both realize where the opportunity is. Because somebody who's selling in a market that's saturated or has other peccadillos like California, you're going to have some issues, and it's better to identify that up front so that you know what you're getting into and how things are actually going to turn out, as opposed to a book that is kind of rose-colored glasses.
Yeah, and Rick, I was fascinated by some of the stats you quoted at the start around private equity's presence almost 2 years ago versus now, and I made a note to get those numbers from you after our call. But if you actually went back, I'm sure a decade, it would even be greater. And the point is a little bit. Wouldn't go far as to say the easy money's been made, but to some extent the easy money's been made. And what that basically means is just going back to the same set of brands that are shrinking is not a great strategy. In order to really earn your keep and make excess returns, you need brands that are growing with white space. And you need brands that are growing transaction, not price. And, there's been two real sins that private equity has committed the past few years, and they're bearing the brunt of it in the form of subpar returns. And the first is, entering consolidated systems thinking they would consolidate further, and not actually thinking about white space. In fact, because white space didn't really exist anymore. And then the second thing is thinking, you could take price by, 5%, but transactions drop 3%, so it's all okay. At some point, you take it one step too far, and that model collapses. So what you really need is that real flywheel of a solid brand that's got a lot of money to continue to develop and spend on advertising, that gives their franchisees an opportunity for white space, and the franchisees have the ability to grow transactions, grow customers, and not rely a little bit on the sugar high of taking a few points in price every 6 months, because that engine ultimately fails.
It's a great point, and I'm bullish on the future of the industry. And to Scott's point, like these legacy brands, a lot of it's been combed over at this point, and picked through. I got a daughter who's a second-year student at Baylor University in Waco, Texas, and they've got this area next to their campus called the Grease Pit. That's what everybody calls it, the Grease Pit. And you drive and go under the bridge and go over there to the Grease Pit. And on one side of the road, you've got all the legacy QSR brands that have been around for 20 years. And on the other side of the road, you got these like HTO and Kava and, In-N-Out Burger and, Hawaiian Brothers and Dutch Brothers Coffee and all these like newer concepts, right? And if the 3 or 4 of us just sat there on the street and just watched the patterns of the customers, we would come to an inevitable and quick conclusion that there's a lot of optimism there to be had in some of these new brands going forward. One of the problems, some of the people who'll be listening to this are people who are in those brands and have 10 or 15 locations, and they're the ones that have a white space that could be another 50 locations across 3 states over the next 5 years. And those are the very ones that are the right types of people, because most of the franchisees who are like that are younger. These, Scott, said these 45 to 55-year-olds who have a lot of ammo in the tank still and want to do it. The problem is that they're just a little bit too small, most of them right now. But that's one of the reasons why I'm really kind of positive about the next wave of this business and of this industry. It's that we're migrating. There's going to be casualties and dead bodies along the way, and we're going to see them with tons of store closures over the next 18 months. It's going to happen, man. You're going to see thousands of stores closing. But like you get past this 4 to 5 to 6 to 7 year window, and I guess we'll hopefully all be young enough to still be a part of it. And I kind of get really bullish and optimistic about what happens 7 to 10 years from now, when some of these concepts can kind of like redefine the franchise business. Some of them won't do well. Some of them will do great, though. There you go.
Well, thank you all for that fabulous discussion. Pivoting to Scott and Kevin now, in regards to franchise equity partners, what can we expect this year?
Wow, that's a great question, and I'm sure whatever I expect, I'll get it completely wrong. But we basically focus on 5 different verticals. So restaurants, automotive dealerships, beverage distributors, heavy machinery, and our vaunted other category, which is just general consumer and business services. If you add everything up, we have about 750 multi-unit retail locations across all our different brands. I think, on the restaurant side, as Rick alluded to, I think the strategy he framed is right. We will look for some interesting high growth markets in attractive parts of the country for the legacy brands. We will look to try to plant a flag in some of these emerging brands that have a lot of growth in front of them, but have enough of a proven track record. That could be in snacks and coffee are 2 great examples of that. I think on the automotive front, we're at an interesting pivot point with the supply chain pressures behind us. And we'll look to continue to grow out platforms in the Midwest, Florida, Texas, the Pacific Northwest. And we also really love the residential services businesses, everything from HVAC, plumbing, electric, to we have a very large garage door business. We're the largest franchisee in the neighborly system. And we think just serving customers in the residential space looks a lot like QSR did 20 years ago. It's just a core business that people need. If you partner with great brands that take care of the customer, there's a lot of runway for growth. But just where restaurants were 20 years ago, residential home services remains very, very fragmented. We see an opportunity to not only grow, but serve as a consolidation platform in that space.
And Rick, how about Unbridled? I know you just closed some pretty big deals, but what's coming up?
Thanks for asking. I think we'll just keep doing what we do. Give me a pickaxe and I'll just keep swinging it at the ground. I've got a great little team, and we try to keep a 90% success rate in the assignments we take, which means for every 20 assignments we take, we want to be closing 18 of them. That's kind of our model. So we're decidedly choosy. And in this, I think, one thing we haven't talked much about, it's probably not the right forum, but the marketplace isn't the best right now. Some brands are doing well, but in many, we're meeting declining traffic, flattish sales, and we're also got, high interest rates and kind of tough lending environment a little bit. So we've taken a lot of phone calls and turned down a lot of assignments this year. I think almost 10 in the last 60 days. I don't personally want to get involved in deals that won't close. So we can't be perfect all the time. But so I think we'll just continue to kind of quietly do what we do. We're kind of expanding the breadth and the size of our business in terms of the size of our transactions and the number of brands that we're operating in. And I don't know, just trying to keep making our free throws, that's and hopefully we can get UConn knocked off this year from the national championship slot. I don't know what you guys think, but I don't want them to win again. Do you guys? Let's cheer for Alabama,
Exactly. Roll Tide.
Roll Tide. There you go.
Well, thank you so much, Scott, Kevin, and Rick, for your insight today. And thank you to our audience for watching. Stay tuned for our next webinar, which I'm also moderating, where we talk about growth from some of our winning deal makers. Thanks, everybody.
Thank you very much.
Thank you, Emilee.